That 1982 to 2022 period was a golden era. Your bonds gave you yield and capital gains, and equities rode that disinflationary wave and globalization for 40 years. And that is one sort of economic regime. And today's regime is very different. You've got global debt levels at historic levels. You've got inflation running above target and being more volatile. If your diversification is relying solely on stocks and bonds and the zigging and zagging between them, that mechanism in this current economic regime is compromised. Assets like gold and Bitcoin, they move with more like inflationary volatility and currency debasement and sovereign credibility. So while they don't produce income, that's exactly what makes them complementary. The fact that they don't produce cash flows, it's a feature, not a bug. That's what makes them diversifiers.
Hi, Mike. Welcome to Excess Returns.
Justin, how are you?
Great. Thank you very much for joining Jack and I today. I think, a lot of our audience knows about Resolve Asset Management. You and the team there are, I think, known for helping investors think differently about portfolio construction, risk management, and diversification, particularly in a world where the traditional 60-40 portfolio might not be enough these days. And you recently co-authored a white paper, Golden Opportunities, Enhancing Traditional Portfolios with a Gold Future Stack, which made the case for gold as more than just an inflation hedge. You kind of were advocating using it in this concept of return stacking, which is, you also run a number of return stacking strategies, where gold would be stacked on top of like a traditional stock and bond allocation in a way to help improve long-term returns and improve with drawdowns and things like that. And so we wanted to walk through that piece of research with you and also talk, I think, a little bit more broadly too about gold and Bitcoin and how you guys are thinking about, and the research you've done around the diversification benefits of bringing in something like Bitcoin as well. And I think thinking about how advisors and allocators can practically implement things like that in their portfolios. And so once, hopefully our audience goes and checks out Resolve, you can check out what they're doing at investresolve.com. And they produce a lot of great research and have information on all their strategies and the ETFs they run and everything like that. So please.
I'd add that to that a lot of this is on the return stacking portfolio solution. So returnstack.com. Where we're talking about these types of positions being layered on top of your traditional assets, sort of like that portable alpha where you're building on top of what you already own. So you're not selling those stocks and bonds you know, love, and trust in order to incorporate these things that can provide some diversification benefits to your portfolio.
Yeah, that's great. Thank you for mentioning that as well. That's an excellent site. Okay, I wanted to ask you, let's start with stocks and bonds. I mean, up until, a year or two ago, it was a great 40-year run for both asset classes. And they worked really well together, and they, bonds sort of did their job of providing diversification, but you also got great returns out of bonds. And obviously it was a good period for stocks as well. But, talk about why that type of line of thinking where just easily allocating to stocks and bonds might be a flawed sort of set of logic that, we might be thinking about in today's market.
Yeah. I mean, you covered a lot of it in that, we've had that 1982 to 2022 period was a golden era. Your bonds gave you yield and capital gains, and equities rode that disinflationary wave and globalization for 40 years. And that is one sort of economic regime. And so the price movements of asset classes, as well as the correlation of those asset classes, often depends on what regime you're in. And today's regime is very different. You've got global debt levels at historic levels. You've got inflation running above target and being more volatile as it does that. The correlation between stocks and bonds becomes positive. And if your diversification is relying solely on stocks and bonds and the zigging and zagging between them, that mechanism in this current economic regime is compromised. So you need different diversifiers that respond to the different forces that are out there, the structural forces. And that's where Bitcoin and gold come in. I'm also remembering that there's that old chart it was Guggenheim who did it originally, but I don't know if you guys recall, they went through the decades of the efficient frontier. And they had each decade, some of them typically being sort of that classic C-shaped, 60-40 was the most efficient portfolio. But when you looked at the efficient frontier in the 70s, it's actually a straight line, right? That stagflationary era in the 70s where stocks and bonds correlated, there was no benefit to diversification. There was simply whether you wanted more or less risk, and the returns didn't increase either. So if you took on more stock risk, you didn't get more returns, you just moved out the risk spectrum. And so when you're in those types of regimes, there's different asset classes that benefit. And cash flowing assets like stocks and bonds, they move with earnings and interest rates and credit spreads and all that sort of stuff. Scarce assets like gold and Bitcoin, they move with more like inflationary volatility and currency debasement and sovereign credibility. So while they don't produce income, that's exactly what makes them complementary. It's the fact that they're priced on a completely different set of risks. And that's why they can add so much diversity into a portfolio, especially in the regime that we're currently in.
One thing I'll always remember, and Jack and I have interviewed maybe dozens or hundreds probably at this point of guests. And so it all kind of becomes blurred, but your partner, Adam Butler, we've had him on a few times, and I'm going to murder this quote, but his point was, the return sequence or stream that we've gotten over the last 20 to 30 years, is one set of an infinite number of possible return streams or patterns. And so you can't take the last 40 years and just extrapolate it forward and say, well, that's going to be the same thing for the next 40 years, because to your point, it could be a completely different regime influenced by different things.
And that's what diversification is too. It's an explicit recognition that we may not know what regime we're in. And in order to deal with that, you diversify with new and different asset classes that respond differently to those structural regimes.
You had mentioned debt and inflation a little bit. Just I don't know if you have any, we're over 100% debt to GDP in the US. Obviously you have things like the tariff deglobalization going on. That's probably going to play, into inflation. You have things in the housing market with housing affordability. Just talk about some of the things that you pay attention to, that you think about in the context of sort of increasing debt, particularly in developed economies, and then also inflation, and how gold and Bitcoin kind of play into that type of macro backdrop.
Right. And that's the key really, is that in that macro backdrop, these assets tend to thrive when you have fiat credibility that's strained. When you don't know how much money they may print out of thin air, that creates issues. We saw it in COVID, we saw it in 2008, and those issues are starting to manifest sometime later. And so when you look at assets that are like gold, they have historically done very well when real yields are falling, deficits are rising, and that sovereign creditworthiness is questioned, right? Bitcoin is the new kid on the block. It's increasingly viewed through the same lens. We'll talk about that a little bit more, but it does deal with that. It's scarce. It's a non-sovereign asset, limited supply in a fiat world. So when you have a macro backdrop of fiscal dominance, rising debt, and inflation volatility, this sets a stage for both of those assets to play a central role in portfolios. Both of them don't respond to cash flows, but rather they respond to the faith and the stability of the monetary system, right? And given what you've talked about, deficits, inflation volatility, fractured geopolitics, housing crisis, that hollowing out of the middle, all of those things really start to put more and more of an emphasis on these assets being very complementary to the traditional assets. And I know I spoke with Meb Faber on his podcast, and he was talking about how they've, at times done back tests where they pull out bonds and they use gold as the diversifier for stocks. And turns out it works about the same. It works at different times differently, but it's a very similar result in that it's not correlated. Now, bonds do have their period where they outperform, and gold has its period where it does a little better. But when you're facing the types of issues that we're facing today, as you mentioned, the amount of debt that we have to figure out, these types of things lead to these assets being very, very complementary to those traditional portfolio assets that everybody knows, loves, and trusts, and has had such good experience with over the last 40 years. The question is, are they going to do the same over the next 40 years?
You may have answered this already, but I think there's something else here. And a lot of the investors that say they would never touch cryptocurrency or Bitcoin specifically is, there's no cash flows associated with gold or Bitcoin. And so that's the criticism, is they can't value that asset, get to an intrinsic value based on some type of, discounted cash flow, because there is no cash flows. That's the case that Buffett has often made against Bitcoin. But for you, how do you frame, I guess, the case? How do you frame that for investors that make that argument that these assets don't have cash flows and therefore you can't value them?
Yeah, that's an interesting one. And that's where you get the phrase sort of psychological commodities. They highlight the fact that the value doesn't come from cash flows, right? It comes from the scarcity and that value of the scarcity and the collective acceptance by a social network that decides that these are meaningful. So until they're adopted broadly, they can look like, pyramid schemes. But once they're adopted broadly and globally, they start to look a lot like gold. And Bitcoin is somewhere on that adoption curve today. And we have collectively decided that gold serves as a store of trust outside of a single jurisdiction. So that's, been accepted. And Bitcoin is emerging in the same role, scarce, non-sovereign, no liabilities, et cetera. And it's got some shared belief in its utility. So I think the other thing to think about there is the feature that's really critical is true scarcity. So when things are scarce or limited in supply, they must be bought from someone else who already owns them. They cannot be printed out of thin air. So let's think about, if the demand for iPhones goes up and we have a shortage for iPhones and price of iPhones skyrockets, what happens? More iPhones are produced. If we need more oil and oil shoots up, more wells are drilled. You need more copper, more mines are dug. Versus gold and Bitcoin, where the supply is somewhat set and the addition to that supply is very limited. And so we see this in things like waterfront property, Mickey Mantle rookie cards, right? They have some collective social value, and due to their rarity, they provide a different structural relationship with these economic inputs that cause them to move differently with their price. Even on the Warren Buffett side, businesses with strong moats, that is somewhat of a scarce asset. And so again, stocks and bonds are priced on those cash flowing items, those interest rates, discount rates, and the growth factors. Gold and Bitcoin are priced on what's happening with the trends in volatility, what's happening in trends with monetary debasement. How are we looking for sovereign credibility? Are we even going to get our money back in a world where we're printing all this money? And these hedge different risks because they rest on, different fundamental drivers of return. So I don't think we should be too worried about this in the construct of a portfolio construction. We're really looking for assets that are driven by different structural drivers. That's what provides the difference in the return stream. And so it's a feature, not a bug.
I don't know if you guys saw, but this morning, for another Canadian here, like Kevin O'Leary and two other guys bought like a $13 million Kobe Bryant, Michael Jordan signed card. So it's one of So to your point, these things that are scarce and people want them, yeah.
Non-reproducible, right? And you're seeing Ray Dalio come out and talk about, allocating to stocks, gold, and Bitcoin. You're seeing Paul Tudor Jones say the same thing. So we have some pretty wise investors that have somehow gotten their brain around the fact that, sometimes not having cash flow to an asset and it rather being scarce is actually something that's quite complementary to the portfolio of cash flowing assets that you already have. That's where return stacking can come in handy too. So let's layer it on top. Let's not sell those cash flowing assets. Let's build them on top. And we can get into that a little later.
Why do you think investors are so resistant to this? And the answer might be different from gold than Bitcoin, but if we modeled this out, these should be part of people's portfolios, and gold's been around forever, and it probably should be a significantly bigger portion of your average person's portfolio than it is. And Bitcoin obviously has some different things that are associated with that. So why do you think, despite the evidence, people are maybe resistant to add this stuff?
Well, Jack, as you point out, it ain't about the math, right? And the diversification case is clear. It is about the psychology. Investors fear looking different than the herd. They want to avoid tracking error, right? And I think this comes back to the first question about the 60-40 portfolio. They're still anchored to that 40-year story. That 60-40 portfolio performed beautifully. Investors' beliefs are formed in their formative years. And we'll get into this when we look at the different cohorts by age. But, most allocators built their worldview in a disinflationary boom, and they're just simply reluctant to update their priors. And, I think the irony here, though, now is career risk has somewhat flipped. I think the real risk today isn't owning some gold and Bitcoin. I think it might be having a zero allocation when your clients ask you, why don't you have something in these assets for me? Over the last 1, 2, 3, 4 years, gold has outperformed stocks. Bitcoin has outperformed them handily. And so the Overton window, I think, is shifting here. And these assets that were once fringe are becoming foundational. That's another article you can get on our website too, Fringe to Foundational, if you want to look through some of the data points. So this is a function of age and those formative years. And I'll give you some examples, right? So Piper Jaffray does a study every year, and it's called Taking Stock with Teens. And in 2021, they surveyed these between the ages of, I think it's like 12 and 21. So the average age is 16. In 2021, 9% of those teens, average age 16, reported having traded cryptocurrencies. Those 16-year-olds are now 21, right? That's a bit mind-blowing. But hey, it gets worse. You not only get the steak knives, the World Economic Forum did a retail investor outlook as well. And 62% of millennials have at least a third of their portfolio in crypto. 35% of Gen Zers allocate over 50% of their portfolio to digital assets. Now, those are different formative years. Now, contrast that to Bank of America, where they pulled their clients, what Bank of America, mahogany money, mahogany desk money. So the Robin Hooders, they're in. The mahogany desk money, Bank of America, 75% of their clients are at 0, and 10% are at less than 4. Only 1% are at above 8%. So there's a couple of things going on there. One is that formative years, right? Where did you start to formulate your investment experience? And updating those priors is hard. And average advisor is dealing with those more baby boomers, senior Gen Xers. And so this represents a couple of risks to the advisor too. One is that, clients turn over and that money gets passed on to the younger generation. And so one of the risks to advisors is potentially that the money that is going to be inherited to this younger generation is not at all going to identify with that mahogany desk mindset. And so it really is, I think, updating priors, those formative years, the 60-40, it's hard to update what's worked so well and what everybody has deemed okay. You're not going to get fired for that stuff. And, institutions are coming in, but they're not at size. And certainly in crypto, I mean, the large institutions like pensions, endowments, those types of things, they're less than 5% of ETF holdings. So you've got this huge mismatch between the generations of what their formative years represent to them. And I think that's probably the biggest hurdle, is just updating the priors of those older advisors and the investors. Because remember, advisors are just usually a reflection of the people that they're serving. That's the same with allocators and their boards.
What do you think the source of anger among old guys like me and you is about Bitcoin? It's interesting. I was listening to The Compound the other day with Josh Brown, and they were talking about, they had put out a video with the Coinbase CEO, and it dramatically underperformed any video they've done in a long time. And they said that's common whenever they do crypto stuff. And the comments are just a disaster. We just put out a crypto video recently and people are like, why are you talking about Tulips 2.0? What is it that what is it that makes us and maybe it's I don't own any of it, so maybe I have anger because I don't own it, but what is it that makes us angry about this thing?
Well, I think you hit on something there about not owning it and sort of looking raw and having experience, right? And having experience that says that I've seen this before and I know how this ends. But I think you got to start to update your priors. And it's hard, right? Again, those formative years are so catalyzing. We lived through pets.com, right? We lived through, things trading at 1,000 times sales and watching wealth get destroyed by those types of things. And so we sort of cling to this cash flow narrative, and those beliefs and priors need to slowly update with the evidence that's changing. So I think it's a bit of, you kind of have to admit you're wrong a little bit, but we'll talk about that a little bit later, because I don't think that's actually true. And I think it's fundamentally the formative years of when you start going through the investment process. I remember being a broker in my early careers in the mid 90s, and I was still dealing with the Great Generation. And they held their certificates and securities and bonds in their home or in a safety deposit box. And if they had it in their home, they were wrapped in tinfoil in the freezer, because they had experienced bank and brokerage house failures. They would never keep something in street name. Never. And why is that? Why do we all think that that's a perfectly acceptable thing to do today? Because the formative years for that Great Depression generation was they actually experienced defaults where they kept money and securities and certificates at places, that place went under and they lost everything. And so I think you can draw a similar corollary to those of us in the baby boom generation, Gen X. Gen X is a little bit of a different, they kind of split. Boomers are classically in this, these are beanie babies. Generally speaking, that is, I'm generalizing, not your boomer, just boomers in general, right? Nothing personal. But I think that it really comes back to those formative years and what you experienced and how catalyzing those experiences were for your behavior. And so you really kind of have to ask yourself, what are you going to do now? As the facts get more clear and sort of head in the one direction, are you just going to sit on these old assumptions, or are you going to update them?
And I think we have to get over some of these things about existential threats as well. Like this idea that Bitcoin is going to be hacked and so I'm going to lose all my money, or the US government's going to shut it down. It's probably time to move past those things. It seems like those are very unlikely to happen at this point.
Well, yeah. And so you've got regulatory clarity, right? And that is a major, major hurdle that's been cleared. And so we can jump into that. But I agree with you. There are existential threats. But you always have to view those threats with respect to the rewards that you can achieve if those threats do or don't manifest. So if the threat is very small and the reward is very large, well, you have to calculate that.
I believe the article you reference is the one where you do this, but you have an interesting article where you look at the path of gold over history. And I think something that maybe make people more comfortable with Bitcoin is looking at that path of gold and maybe looking at Bitcoin as well and how they might track each other. So can you talk about that a little bit?
Yeah, of course. So gold moved through very distinct phases, but I guess it did it over many decades, allowing a lot of behavioral shift to happen under the surface. So gold under the Bretton Woods scenario, pre-1971, was a backing to currency. So it was a zero return anchor. It was when we had hard currency, right? And then post 71, we entered a fiat currency era where, now you have a free floating currency delinked from a hard asset. And so with that free float comes market driven forces that are impacting gold vis-a-vis the fiat currency. That's where you get this risk premium that develops. And then what happens? Well, that happened first, but the asset was not financialized yet. So how would you go get gold? You'd have to go buy bars, figure out where you're going to store it, buy a farm up in northern Canada. This is a kind of a true story. John A. Templeton bought an apple farm up in the wilds of Canada from someone I know, and then buried gold there. So it's wild, but that's how you'd have to do it. But then what happened next was, and think about that. You had to, if you were going to buy Bitcoin, you had to go get your keys, you had to get your phrase, you had to save it somewhere. A lot of barriers to entry. But in the 2000s, what happened with gold is we had GLD, we had the ETFs start to be offered. And those ETFs offered great places for futures to start to hedge against those and have the deliverable contracts against actual ETFs that track the price. And so it became a fully investable return source for investment portfolios for both institutions and individuals. That's when it started to get fully financialized. So you could build it into your portfolio's efficient frontier. Prior to the early 2000s, I mean, you could have your gold and you're buried in your basement. Then you got to do rebalancing. So you got to go get your gold, sell it to the thing, transfer for a process. That has implications too, because then those assets move a little bit differently. But Bitcoin is following that precise same path, from a niche experiment to a kind of a speculative outsider to now post ETF approval, clarity with the SEC and NFA on who regulates what, how they're going to be taxed. So now it's professionally accessible as an allocation. So now the arc is very similar, right? First as money, then as a hedge, eventually as a structural portfolio asset. The difference is obviously the pace of adoption has been much, much quicker. It's been 15 years. And, we also have the regulatory and legislative clarity that has come about in the last sort of 6 months or so. So all of these things really kind of line up Bitcoin in the same way that we saw the progress for gold go, although just timelines are compressed today, as we all know, as we experience technology and the pace of information sharing.
How do you think about this debate about what Bitcoin is? Like for a very long time, people would argue, and the data for a period of time would support this, that it was basically like a leveraged version of the NASDAQ. It would go up or down when the NASDAQ went up or down, but by a lot more. But recently we seem to have seen more evidence to support the digital gold argument. So how do you think about this idea of like what Bitcoin is?
Yeah. So from a portfolio context, I don't want to get into if you want to know what Bitcoin is from a fundamental basis, just go listen to Michael Saylor. He'll tell you better than me. I'll think about it from a portfolio construction perspective. At first, it certainly was a growth asset. It's kind of correlated to the NASDAQ. But again, adoption continues to widen and it's starting to act a little bit more like gold. It's acting a little bit more as a monetary debasement type of asset, because there will only be 21 million coins, because 95% of them are already mined. It's responding to that geopolitical risk. You're seeing some sovereign nations start to establish a Bitcoin reserve. The US has stated so as well. And I expect that to continue. And over the long term, as liquidity deepens, volatility probably falls. We've got to get more institutions involved. We've got to get more of that long-term money involved. I think Bitcoin's role should converge to gold with that, sort of scarcity, non-sovereign store of value. But I think we're still in the time where we're going to have a bit of dual behavior, risk on correlations at times, structural diversification at others. But, the other thing that Bitcoin brings to the table is the tailwind of a broader adoption, which can give it more asymmetric upside returns, which we talked a little bit. And I think those can sort of offset some of those risks, those existential risks that you mentioned earlier. So again, you've got to weigh, what's the return potential, what's the risk, and what's the contribution, the differentiated contribution to the portfolio. And I think for a while, still Bitcoin is going to walk that dual personality.
One of the interesting things is I think career risk is starting to flip with this a little bit. Like for a long time as an advisor, if you had this in the portfolio, like your clients did not want to see it. They're like, what are you doing? Like, why is this in there? And now it seems to be more and more like, why is it not in my portfolio? Like, have you seen that as well?
Oh, without a doubt. And as we talk with advisors, they're feeling it too. So in our day-to-day discussions with folks about, are you seeing this kind of flip, this shift? And, for years it was safer to ignore Bitcoin, right? You can't get fired for owning that. It's kind of one of those things. You're just in a lose-lose scenario. You put it in, it goes down. You get fired, you put it in, it goes up, and they still don't like it. So, today, however, there's a few fundamental changes, right? You now have legislative and regulatory clarity. You now have spot ETFs. You now have sovereign nations holding reserves. You have central banks buying gold. You have major firms like BlackRock and Fidelity involved. So the reputational risk, in my opinion, is flipping, and we're seeing that in the feedback from clients to advisors. Clients are asking about it and why, I think explaining why you own zero is probably the new career risk. So it's becoming professionally safer to have a thoughtful allocation, I think for sure. And even despite what we hear from the compound, and I agree. Like I hear that, and I think that's mahogany desk money talking, right? And it's those formative years for those clients that they're serving. And so the last thing I want to say on this, well, maybe it's not the last thing, but what an important thing I want to say on this is I think advisors and allocators have been caught in a framing issue. And, I want to help with that. And I think the framing issue is if I allocate now, I've been wrong up until this point. Fuck, it wasn't Beanie Babies. Or I don't know if we can swear on this, or damn it.
We certainly
shucks. Can. Yeah, shucks. It wasn't pets.com. So now let's reframe that a little bit though. I think advisors should emphasize the fact that they haven't been wrong at all. They've simply been prudent. You didn't have regulatory and legislative clarity. You did not have that. You did not have other respected investors like Paul Tudor Jones and Ray Dalio coming out publicly in support of this. So I come back to that John Maynard Keynes quote, as facts change, I change. What do you do, sir? The facts have clearly changed. United States of America is going to be the central clearing point and going to be a major player in digital assets. That has been set as a primary goal at the administration. They've clarified regulatory issues with the SEC and NFA. They've clarified legislative opportunities as well. So now, advisors need to think through that and say, wait a second, my fiduciary responsibility is not really to sit on zero. It's to observe the facts as they've changed and start to allocate responsibly for those situations where it fits. Right? The fiduciary obligation is that they should be considering these assets. Now, they have not had those clarities until now. So you haven't been wrong. You've simply been prudent. You now have clarity. And now you've got to start thinking through how you're going to adjust your portfolio allocations.
This gets at one of the hardest things in investing, which is buying up. I'm kind of like by my nature a value investor, and like you've got to be able to do that to be successful in investing. But like a lot of people like me are probably looking at it. I could have bought this thing when it was $2,000 or something. Like why am I going to pay these high prices? Like that gets in the way of successful investing. I think a lot.
A lot. Look at Amazon. How do you rationalize buying Amazon today? I mean, it's up a lot. So I would say that some of that are my friends doing it? And if they're doing it, I'm okay with it. But if my friends aren't doing it, it leads to some tracking error. It leads to those other challenges, they're more behavioral gaps than anything else, right? So there's other frictions too, right? So I think what we're talking about here is the sort of the implementation gap. Okay. So, all right, we're nodding along, Mike. I got it. Yep. I got the regulatory clarity. My clients are asking me. Yep. And if my clients die and they pass it on to their kids, I'm going to be out. Okay. And then they don't do anything. And I think there's a lot of frictions there too, because we're in the early innings of this, right? So you got to look at your IPS language. Does it even include digital assets? Does your firm allow that? What's your custodian like? So there's a lot of things that need to be worked through, but that's just work, right? That's just what you're supposed to do as a fiduciary. So if the facts have changed and you need to update IPSs to include a small allocation to digital assets, that can be done. That's not hard. You need to walk your compliance department through that and make sure they're on side, and they're coming on side. That's not impossible. ETFs have simplified custody and using approaches like return stacking so that you don't have to give up exposure to equities that love and trust. Those are helpful tools. And so now you can, add an allocation. You can keep your tracking error low. You can keep your behavioral regret low. And, if you start small, it'll be easier to stick with while you build that intuition, right? If you still stay at zero and next year it's at 300K, well, then you're going to be you're going to be punching yourself in the closet again. If you start small with an allocation that you can rebalance to potentially, and you build intuition around the asset class, and the asset class treats you well, or it doesn't, and you kept it small enough you could rebalance to it, now you're starting to make progress in the right direction.
And one of the other challenges too is people have this thing about flipping the switch on and off. Like I either have no position or I have this massive position. And one of the things I've
Right.
learned from you guys over the years, the stuff you've done with risk parity and other stuff, is like sizing is so important with this stuff. And it's not a decision between some massive position and zero. Like there's a lot of room in the middle.
Without a doubt. And sizing in these types of assets that are new can be somewhat volatile, but gold isn't that volatile. It's more new. So the client lacks and the advisor lacks intuition. They haven't had them in the portfolios. They don't kind of know how they act in different situations. They don't have that confidence. So when you lack that confidence, start small. Act from a position of strength. Use a position small enough you could always rebalance to it and not think too much about it. And then when it starts to treat you well, maybe you don't rebalance down. Maybe you start to work towards that final allocation that you want. Think about where you want to be, work it back from there, take small steps, build intuition for both you and your boards or your individual clients. And, that's the way to thoughtfully get it into portfolios.
Another way to look at it, right, would be to look at what its percentages of the global market portfolio. If that's probably a good starting point for a lot of people, right? It's not a big number. It's not a huge position many people think it might be.
Exactly. So if we go through that math and you say, okay, let's consider this. The US equity market is about 56 trillion. Bonds are another 55 trillion, roughly giving you 111 trillion in core assets in the US. Crypto market is somewhere between 3 and 4 trillion, depending on the day. So it's going to be somewhere around 3% of that investable set. And so the 3% weight is neutral. If you're at zero, you're actively short this asset. So the neutral weight versus stocks and bonds in the US is 3. If you're at zero, you're short. Shorting is probably the most ultimate speculation, right? So if you believe in passive investing and you believe in owning a market portfolio, the neutral allocation for crypto is about 3%. For gold, it's bigger because the asset's been around longer. So market cap of, call it 15 to 17 trillion for gold represents about 14% of stocks and bonds. So there's the neutral rate that you should maybe consider working towards. And I know that's going to make people lose their freaking mind. So I don't want to start. Let's not start there. By the way, a little pitch for our ETF that stacks the gold and Bitcoin on stocks, that if you did a 15% allocation to that, you get your stocks back and you get about a 3 and 12% allocation to gold, a 3% allocation to Bitcoin. But that's asking a lot. I do understand that that's asking a lot, but that is the market cap weight. So if you wanted to be neutral, that might be where you want to work towards. Now, how long it takes you to work towards that is your own preference, but it's a place to start as sort of an outside thumb in the air allocation that would be more neutral.
How do you think about the long-term real returns of something like this? It gets back to the cash flow thing we talked about before, but a lot of people would tell you would think gold doesn't have much of a long-term real return, but it actually does. I think it's 2% and change. You can correct me if I'm wrong with that. But like, how do you think about what drives that? And how does that relate to what also might drive the return of Bitcoin over time?
Yeah, they're directly related, as you might expect. So, the gold risk premium comes from absorbing those monetary and political risks, right? Investors demand compensation for holding a non-yielding asset that hedges inflation, debasement, crisis, all that sort of stuff. So that's why it's delivered those real rates of returns. And Bitcoin is molding itself in that same regard, has that asymmetric growth profile potentially, but it's that same scarcity narrative, right? They respond to different structural drivers in the economy, which is what makes them structural diversifiers for the portfolio as a whole. And I can just come back to Bitcoin has that extra feature of being a little bit earlier in the adoption curve, which can have some impact on having some increased expected returns that can offset its higher volatility because it's earlier in the adoption phase and it's got a lower base rate in portfolios. But I don't really want to make it about predictive. Let's just make it about getting the portfolio to an optimal place where you've got something in the portfolio that is structurally different than all those stocks and bonds in your portfolio. And, the other thing that these assets do is they respond well in US dollar weakness. So there's no question that if we look, at US stocks, largely there's a large home country bias in US portfolios. So you're starting to see international stocks do much better, right? Part of that's driven by the fact that the US dollar has had its worst first 6 month start since the 70s. And that's a stated objective by the administration. They want a weaker dollar, and they've executed on a weaker dollar. That has implications for your portfolio. That is another reason where items like Bitcoin and gold actually provide a little excess return, because they're denominated in US dollars. As the US dollar falls, they rise. So it's just another way in which they have structurally different drivers that actually complement those things that are in your portfolio already, those cash flowing assets.
Do you think as we think out longer term, I was just thinking about this, do you think these are Bitcoin and gold are always going to be complementary to each other? Or do you think they eventually will be in conflict? Like some people argue the opportunity for Bitcoin is the assets that are in gold. Like, do you think there's going to be room for both of them long term, or do you think one of them will take away from the other?
No, I think they're very complementary. I kind of laugh when you get Pomp and Schiff arguing it out about which is better, to be honest. It's kind of funny. They're on the same side of the boat. They have the same drivers. It just seems so strange to me that they take that approach. They're very complementary, and it's not a choice. You don't have to choose in your portfolio, right? And Bitwise has got a great paper as well for people to reference, where they walk through 1% to 5% Bitcoin in a portfolio, how this crazy asset, actually, when you add it to a balanced portfolio, increases return and reduces risk. Right. And gold has the same sort of benefits. It's kind of like when you add a little bit of salt to your food, right? A little bit enhances the dining experience substantially. So, and a little bit with the Bitcoin side of it, because of the convexity, really adds some juice to the portfolio. And, you don't want to size it like equities. The other thing that I hear is, it's so volatile. Well, do you own NVIDIA somewhere in your portfolio? I mean, if you own the S&P, you own NVIDIA. The implied volatility of NVIDIA is like 50% higher than the implied volatility of Bitcoin at the moment. So again, these things are all kind of false objections in my mind. They're objections, but if the volatility is high, size it lower. The opportunity set's bigger. So you don't have to have as much to have that same allocation in the portfolio. You definitely don't want the maniacs running the asylum. And that's what sizing your Bitcoin is all about. You don't want the tail wagging the dog. So, and that is really about thoughtful allocation. That's kind of the way we look at it.
It's funny, going back to Adam's quote, like one of the things I've always said to myself and tried to remind myself of constantly in my career is I have this saying, I don't know, so own both. And like that applies to so many different things. Like it applies to factor investing where we operate. Like, whoa, was this factor better than this factor? Well, let's use both factors. And I think that kind of gets to the same arguments you're making here is none of us know the way the future is going to play out. Like it might be good to have both options depending on what that is.
Yeah. And we take the approach of, how do you do that sort of parsimoniously? So we take the approach of saying, well, why don't we size them via their volatility, right? So they're both diversifiers. Bitcoin tends to be 4 times at the moment over the last year or so, 4 times more volatile than gold. So you'll hold $1 of Bitcoin and $4 of gold. That way, when you put your risk goggles on, they actually have equal contribution of risk to the portfolio. And you don't have the maniac running the asylum. And so that is a parsimonious way to look at it. And then we look at that over a 500-day period so that it's constantly updating. Because as we've talked about previously, if gold continues or Bitcoin continues to attenuate its volatility, you want the portfolio to reflect that. So you want to be both risk-weighted and adaptive.
Just one more before I hand it back to Justin. You've referenced return stacking a few times in here, but I just wanted, for people who aren't familiar with it, I wanted to define it. So can you explain what return stacking is?
Absolutely. So return stacking is a form of portable alpha, a fancy word that pension funds started using back in the day. So, pension fund knows that it's not going to sell its S&P assets forever, right? It's always going to have those. So that kind of becomes lazy collateral. It's collateral that can be used to deploy diversifying strategies, right? So rather than let that collateral sit there and just, earn its share. What you can do is you can use that collateral to add strategies and asset classes on top of it. So rather than in the classic case, you have your 50, 30, 20 portfolio, which is, stocks at 50, bonds at 30, 20 is alts. And that's converse to the 60-40 portfolio. So you're selling some of those stocks and bonds love and trust in order to add your diversifiers. The challenge there is that creates more tracking error because you've funded your alternatives with the stocks and bonds that everyone's tracking you on and that everyone has a great deal of confidence in. Rather, let's stack them on top. And that's what return stacking seeks to do. It takes the beta that you already have, stocks or bonds, and it stacks on top of it the diversifying assets. So in the case of Bitcoin and gold, RSSX, the ETF, which is US stocks, Bitcoin and gold ETF, every dollar in the portfolio gives you $1 of US equity exposure and $1 of a gold Bitcoin portfolio. And that gold Bitcoin portfolio is, 80% gold and 20% Bitcoin. And so that gives you an equal risk-weighted portfolio that sits on top of your stocks. So you don't have to sell those cash flowing assets and those moat businesses that you just know, love, and trust and have a lot of faith in while you're adding these diversifiers to the portfolio. These assets that are structurally different from the stocks that you're holding.
One of the things that is great about ETFs, like you're talking about, and all ETFs have this feature, is you can go to the ETF site and you can actually download the holdings in basically real time. So you're seeing end of day as of yesterday. And I just thought, just real quick, just to kind of round what you were saying out, I just thought maybe we could bring up this. I know it's an Excel. It's not I just pulled it down real quick, but I thought maybe you could just talk to this, kind of flush out like exactly what you were just describing, basically.
Right. So when you look through this, you're going to see the IBIT ETF. You're going to see the IVV ETF. And so we try to hold as much of the actual physical thing as we can. But then we need some money to fund the balance, to create the leverage, to create the other exposures. So in this case, you've got 68% in IVV and 12.5% in the IBIT ETF. And then we use the balance of cash that's left to recreate the performance of gold and the balance of the performance of stocks and Bitcoin. So we are using leverage in order to create $2 of exposure for every $1 that's given to us. And we want to make sure that that $1 that's given to us, or that $1 that's given to us, we're going to give the investor back all of their exposure to the S&P 500. So in this way, if you were to take your 10% of your S&P and say, well, I actually like the idea of building these resilient, structurally different asset classes into my portfolio, but I don't want to sell my S&P 500. No problem. That's precisely what return stacking seeks to do. So we're going to give you back that 10% of S&P. And then on top of that, we're going to give you $2 of Bitcoin and $8 of gold. And we create that through the use of futures. So there is a bit of funding costs in this. But what we want to do is make sure that you're not having that tracking error of having sold your S&P 500. And, we find the behavioral gaps are really harder to overcome than the little bit of financing costs from recreating the portfolio using futures. And you have to remember, using futures really is one of the cheapest ways in which you can achieve leverage. It gives you, that exposure at what is kind of SOFR rates, or what used to be LIBOR rates. And so Bitcoin's a little bit more expensive, so we try to prioritize using the Bitcoin piece in there as much as we can.
Mm-hmm.
But so that gives you that core position back and stacks those alternatives on top.
That's great. Thanks for letting us share that. I think it'll be valuable for our audience to see it kind of in the numbers,
Yeah, absolutely.
One of the things I'm just curious about, have you guys done or considered anything like layering in like trend following? Because both of these, both gold and Bitcoin can go through long periods of sort of, rough periods, bad performance, big drawdowns. And has there been any consideration of like using trend in here?
So not in this particular product.
Okay.
We do have trend as a strategy where we replicate a full trend suite across commodities, currencies, stocks, and bonds that layers on top of either stocks or bonds. But you raise a good point. Like, dead money periods are real. Gold went through that in the 80s and 90s. Bitcoin's had lots of drawdowns. That's been well publicized. But I want to make sure we are fair here, and we highlight that equities face the same problem, right? In the 70s, it was, lots of volatility and no return. From 2000 to 2010, the same sort of thing. So I think the first step is that diversification is the explicit recognition we don't know what's going to happen in the future. And structurally, I think we've got some hints that we're maybe more in the inflationary volatility side, and maybe we have a little bit more debt. So we have a little bit more fiscal and monetary uncertainty. So I think structurally, gold and Bitcoin deserve a place in portfolios today to hedge against the environment or regime that kind of hurts stocks and bonds the most. We saw that in 2022. Now, can trend following help? Of course it can. But you know as well as I do that whether you trend follow in stocks or gold and Bitcoin, it changes the character, right? You do attenuate the declines, but you'll often not participate in the V-shaped recoveries, or you'll have some loss of return from those V-shaped recoveries where trend following gets you out. It's a false signal, and then you have to get back in subsequently, and you lose a little bit of those returns. Risk adjusted, it usually works out to be the same. Absolutely, it could be done. It's just not the approach we've taken in this particular product.
We always want to make sure we give a balanced approach. And I think this conversation has been balanced. I mean, it's been realistic, in terms of how all of these asset classes sort of can behave, and that, no one knows the future. Hopefully that has become clear with this honest discussion. But if you were to think about what are some of the risks that maybe we're not thinking of? I'll give you one. I don't know. This is kind of coming out of left field, sort of, but it was a couple of weeks ago. I was reading an article in the Wall Street Journal on quantum computing.
Right.
And I believe in the article, I don't think, because I'm not smart enough to think this, but I think they were talking about being able to use quantum computing to be able to kind of hack into the Bitcoin blockchain, and how the number of calculations that a quantum computer can calculate is something just absolutely ridiculous. So, I mean, is that, what are your thoughts in general? It doesn't need to be on quantum computing per se, but just as some of the risks here that maybe are there.
Yeah. And I think that stems back to the existential risk that Jack mentioned earlier on too. So the quantum computing, I've read a couple of different takes on that, and it would be hard and costly to hack the network, but I don't think it's impossible. Also, it wouldn't be just Bitcoin that would be susceptible, right? So there's a lot of things that would fall prey to that type of thing, and I'm not sure the value of them. Bitcoin is, call it 3 trillion. What else would you hack in banks and the security in banks and your assets if you had the ability to hack for quantum computing? I think you would have better targets than Bitcoin, actually. I think you'd tap into sovereign reserves or cash assets because they're, orders of magnitude larger. So that is a problem, but I think it represents a problem across a wide array of domains, not just Bitcoin. But, having read a little bit of it and not understanding it totally and fully, I think it's a remote chance, but it's a pervasive risk across a number of domains. It's not just Bitcoin. So I think that's definitely a risk, and it's one of those existential risks that you have to weigh against the potential benefits. But again, I guess gold in a safe, as long as you knew your combination, would be safer. But if they could hack into, GLD somehow and abscond with financial assets, that's a problem too. So yes, it's there. I think it's evolving and developing. It bears watching. And I think, there are risks, right? So if we think about the risks, quantum computing is one.
I guess gold buried in the backyards, similar to cold storage.
Exactly. We're going back to my Great Depression clients in the 90s who had their certs in their fridge wrapped in aluminum foil, or had it in a safety deposit box, off chain, if you will. So, but there are others, right? So what happens if we re-enter some sort of long disinflationary boom? It's hard to imagine that, but in a period of abundance, that gold and Bitcoin would underperform. That gold certainly did from 1982 to 2000. It was a monster underperformer. So, those would be a drag on returns. I think another really interesting risk or relevant risk is that governments, as we've seen, can exert enormous amounts of control over industries and individuals, right? Policy and regulatory actions recently have been very friendly. Prior to this administration, they were not very friendly. So what are the chances we get back into that type of environment? Okay, that's another risk for sure. Another one is going to be behavioral, right? Can investors, as they adopt these new asset classes, can they build the intuition and the ability to stick with them and continue to have them in their portfolios in the long run, so they actually get the benefits of those assets without quitting on them beforehand? And that's why, that allocation methodology is very important. Making sure that you're there for the long run, size prudently, manage risks around that. But let's be honest. The biggest risk thus far for the average portfolio is been being underexposed these assets. They just haven't been in portfolios. 95% of Bitcoin has been mined, and it is not in 5% of portfolios, right? It is, we were talking about that Bank of America study. Like 85% of their clients have less than a 4% allocation. If you look at institutional holdings in the ETFs, those are less than 5% of those holdings. So the one risk that's been clear, present, and existing is the underallocation to these structurally different assets so far.
And I think as we kind of wrap up towards the end here, I want to ask you about tokenization. And I don't know if you happen to catch like the Robinhood thing where they're tokenizing stocks and being able to offer those tokens over in Europe and stuff. And just the concept of, and this is all done via the blockchain, and blockchain specific to these companies, not necessarily the blockchain but the same underlying concept and technology. And I thought it was kind of interesting. I was listening to Tom Lee on the Compound over the weekend, and he was just talking about the massive amount of innovation that is actually going to be happening in our financial system as the financial system and all these legacy systems just kind of get rewritten and put on chain and things like tokenization. So I know we're kind of stepping out into like the 30,000 foot view here at the end, but I'm just curious as to sort of some of your thoughts on that.
Well, now we're stepping into the sort of Ethereum, Solana, Tron era, right? Where you've got these settlement rails. And let's face it, we have not updated the Swift system since since the 70s. So just like the internet kind of intermediated a lot of things like media and so many things, the delivery of products, the blockchain technology is going to create that opportunity in the world of financial services and banking, the way in which we settle. I don't know if you've ever had any settlement between peers with cryptocurrency, but it's immediate. Right. It's not, I don't have to do it. I don't have to go into the bank's login system to send you some amount of anything. I can just send it and it's there within 3 to 4 minutes, even less at times. So I think there's a huge opportunity there. It's slightly different, right? Those are technologies that are going to benefit companies. And so here's the bifurcation. Bitcoin is the store of value. It is the gold. So that's fine. That's the one use case we're talking about today. There's a whole myriad of other use cases. And as Tom Lee pointed out, it's going to impact profitability in bankings, and they're going to lose some lines of businesses, but they're going to gain some other lines of businesses in that. If you think about AI going forward, if you think about all of those types of transitions in value between peers, all of a sudden you move into this electronic world, the old system is unlikely to be able to keep up with that. And the other thing is, we've got Coinbase in the S&P 500. So you are seeing some of this technological revolution being reflected in stock markets. But this is something that Rick Edelman points out. Stock markets have been very good at capturing innovation, right? They've been very good in whether it's Amazon or Microsoft. They've been very good, Google, in capturing what was a nascent technology and bringing it to the masses so that we can all benefit from it from a productivity perspective. Now we have this whole world outside of Bitcoin and that operates outside of the stock market. and it is adding tremendous value. And nobody has an allocation to it. Not nobody, but the world of investors is severely underinvested in this world of technological revolution and advancement. So that's another thing where that might not be a today story, but when you think about the way the stock markets have captured innovation and been able to provide that for investors, and we have all of the rails and comfort with that domain and era to access those, there's a whole myriad of those similar technologies that are developing in the digital world that aren't on stock exchanges, that you have to have set up with accounts and exchanges in different places that are a bit weird and strange to TradFi investors. And so they're being left out of those. And so there's an innovation gap that's occurring where that value is only accruing to a very small group of investors who are willing to go into that area. And so that's another risk that's out there, like that you're pointing out. Now, some of that's going to bleed into the stock exchange and the stocks that we know, love, and trust. But there's a whole bunch of it that's going to happen out there that we're not going to have access to unless we start to think about that domain in part of our investment portfolio. That's going to fall outside TradFi probably, but you've got Solana ETF out, you've got XRP, you've got the Ethereum ETF. So you've got ways to participate in TradFi in those, but there's a lot of other smaller cap things that are happening that could provide a lot of value and a lot of growth, but they're just underinvested for the average investor.
So speaking of the average investor, the closing standard question we like to ask is, based on your experience in the markets, if you could share one lesson with your average investor, what would that be?
Yeah, I think the enemy isn't volatility or leverage, it's behavior. The portfolio you can actually stick with will always outperform the one that you're going to abandon at the wrong time. So, be thoughtful, don't be scared. Most investors underperform because they abandon the assets they picked due to timing, right? They end up capturing the downside, locking in losses, and thereby never getting those excess returns that they're supposed to get because of their poor timing. So really be thoughtful about sizing whatever something is. If you have a domain of comfort, you're just like, it's the Bitcoin hodlers, the hold on for dear lifers. They're committed. They have a belief. And if you have a belief in value or you have a belief in market cap, you have a comfort there. You're going to stick with that. When you add other things that are a little bit outside of your domain of expertise, start small, build intuition, operate from a position of strength. So build a little in, a little bit so you could rebalance to it if it betrayed you, if you will. And then as you grow that intuition, you can build that allocation over time. As you said, Jack, it's not 0 or 1. We don't have to go from 0 to 1,000, right? We can go small incremental steps, build it in, build the intuition so that you can build that understanding of whatever it is that you're adding and making sure you just don't abandon it at the wrong time.
Great discussion, Mike. Thank you very much.
Well, thank you for having me, guys. It was awesome.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.